In this video, I want to start talking about the relationship between different kinds of loans and the interest rates that they charge. Because we've seen so far, I think, that there's a great deal of variety in the difference between the interest rate on a mortgage and an auto loan. And as we see more and more different kinds of loans, we're going to see a bigger variety in the interest rates that can be charged. So, what I'm going to do right now is I'm going to go over to the ESL website. Um, and we're going to look at the current interest rates for a bunch of different loans. And we're going to be able to kind of spot some patterns in there. All right. So let's start off with home equity loans. So this isn't exactly a mortgage, but if you've completely paid off your house and you want to get a loan against the value of your house after that, it's called a home equity loan. And so here are the rates based on how much you want to borrow and the term in months. So the maximum loan to value just means what percentage of the value of your house are you wanting to borrow. So for instance, if I have a house that's worth $200,000, then up to 80% means this is the rate that I would get if I'm going to borrow somewhere $160,000 or less. If I want a little bit more than that, I can borrow up to $180,000, which is 90% of the value of the house, but you'll see that there are different interest rates there. Okay, so if I'm borrowing up to $160,000, if the term is between 48 and 60 months, so that's between 4 and 5 years, I'm paying 2.85% interest annually on that loan. If it goes an extra up to 10 years, then the interest rate goes to 3%. 180 months would be 15 years. So between 10 and 15 years, the interest rate moves to 3.25%. And up to 240 months, which is 20 years, the interest rate is 3.7%. And the same thing if I want to borrow that little bit of extra money, somewhere between $160,000 and $180,000 in my $200,000 house example. With those different times, the rates would be 3.35%, 3.5, 3.75, and 4.2. All right. So what I'm going to ask you to do in the homework assignment is to look at how these patterns of interest rates are changing. And I want you to kind of guess why you think they're moving in that direction. All right. What I want to do from here is let's move over to the page where they're talking about car loans. All right, so here's the rate for car loans. And what this is based on is the year that the car was made. All right, so if it's a new or a current used car, so if it was made between 2020 and 2022, we've got these rates up here. If the cars are older or super used, then we're going to look at these tables down here. All right, so up to 66 months for a new car, which is 5.5 years. The interest rate is 3.59%. Going up to 6 years, it's still 3.59%. Moving up to 73 to 75 months, it's 3.79%. And then 76 to 84 months, which goes up to 7 years, the APR moves up to 5.04%. And you can see, pause the video and look at the patterns for the other types of cars. And once again, I want you to take some time to spot the patterns in this. What kind of factors are influencing the rate of the loans? Okay, the next thing I want to show you is what's called a personal loan. So this might be a loan that you take out. Maybe you're going to get your kitchen repaired, or maybe you want to take a vacation or something like that. Or, maybe you just want to, you owe money to somebody. And so you want to take out a loan so that you can pay your parents back for some money they loaned you a while ago or something like that. So they don't have many details about what you're doing with this money. And so if you're going to borrow this money up to 48 months, which is 4 years, the interest rate is 7.95%. and then it goes up to 8.9 or 9.95%, depending on if you want your loan to go up to 5 years or between 5 and 10 years. Okay. And the last thing I want to show you is I want to show you the credit rate, or I'm sorry, credit card rates. Okay. So we'll talk about these different terms a little bit later, but let's just focus on the first line. All right. So the first line says that for 12 months, they're going to give you the money at 0% interest. You don't need to pay any interest on the money you borrow, or on the things you buy with your credit card in the first year. And then after that, the APR is going to be between 8.25% and 17.49% based on your credit worthiness. Okay. So once again, I'm going to ask you some questions about what you think that means and why you think the patterns of loans are the way they are. Okay. I'll give you a hint. They don't have higher rates because they don't like you. They don't have lower rates because they do like you. They probably have higher rates because those loans are riskier, and less risky loans have low rates because they're competing with other banks, and other banks are keeping their rates low. They would get all of the good customers if they offered better loan rates on safe loans than ESL did. Okay, so ESL definitely has some math calculations based in having those rates be appropriate to the amount of risk they're taking. I want you to think about those concepts and answer the worksheet that's in Schoology based on looking at these numbers.